Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Tuesday, the 6th of February. I'm Daniel Lam, your host for the podcast. Over the last couple of podcasts, we've been focusing upon the latest macro events in the US. However, India has also got blockbuster macro announcements in these 2 weeks. First of all, there was the Indian budget last week, which we believed maintained the macro stability in the Indian economy. Financial year 2025 capital expenditure is forecast to increase by 17% to a record 11 trillion Indian rupee, which is about 3.4% of the GDP. Now, much of this is concentrating upon upgrading the aging infrastructure in the country, long considered one of the Achilles heel of the Indian economy, with high outlay in railways, roads, renewable energy, as well as housing and agriculture. This would keep domestic growth strong and support job creation. On the other hand, they are sticking to their fiscal consolidation path. The government sets FY 2025 budget deficit at 5.1% of GDP. That's compared to 5.8% of GDP for FY 2024. And the government is prioritizing fiscal consolidation through rationalization of subsidy-related expenditure, lower outlay to the defense sector, and state-owned enterprises. Now, for this week's Monetary Policy Committee MPC meeting, it is likely to maintain its withdrawal of accommodation stance, which gels well with the fiscal consolidation path. The focus will be on MPC commentary amid a likely continued downtrend in the headline CPI. We expect the statement to be more balanced than in December. Comments from the RBI governor in the middle of January indicated increased comfort on the inflation trajectory, with increasing visibility on headline inflation trending towards the MPC's 4% target. A faster pace of fiscal consolidation is also likely to comfort the MPC on the inflation path ahead, although the MPC will likely refrain from sounding outright dovish amid geopolitical uncertainties and frequent food price shocks. So what does that mean to investors? Well, this healthy mix of growth versus inflation, with election-related spending and consumption demand, is likely to support Indian equities. Nifty is hovering around all-time high, with higher-than-average valuation offset by an average of 15% EPS growth over the next 2 years. Meanwhile, we believe the medium to long maturity bonds have reasonable risk-reward, with attractive carry and improving demand and supply dynamics on lower government borrowing in FY 2025 and India's inclusion in the Global Bond Index. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.